Have you ever heard of a single trading day so catastrophic it wiped out fortunes and sent shockwaves through the global economy? October 19th, 1987, Black Monday. The Dow Jones Industrial Average plummeted by a staggering 22.6%, the largest one-day percentage drop in its history. Amidst this carnage, while most traders were watching their careers evaporate, one man did the unthinkable. He didn't just survive, he thrived. His name is Paul Tudor Jones, and he reportedly walked away with an estimated $100 million in profit. How? How did he stare into the abyss and not only avoid falling in, but actually leap to new heights? This wasn't a stroke of luck. It was the result of a disciplined, almost religious adherence to a set of rules that are as relevant today as they were over 3 decades ago. Paul Tudor Jones, or PTJ as he's known, is a legend not just for his incredible wealth, but for his longevity in a game that chews up and spits out even the brightest minds. Today we're going to dive deep into the core philosophy of this market titan. We'll explore the 4 pillars of his trading strategy, the very principles that allowed him to short the 1987 crash and build a multi-billion-dollar empire. These aren't just tips for Wall Street pros. They're timeless lessons in risk management, discipline, and humility that can apply to anyone looking to navigate the unpredictable waters of the market. So stick around, because understanding PTJ's mindset might just be the most important investment you ever make. Let's start with his first, and perhaps most crucial, commandment. Never let one mistake destroy weeks or even months of hard-earned progress. Imagine you've been trading diligently for 2 months. You've been disciplined, you've made smart entries and exits, and your account is up a healthy 10%. You feel good, you feel smart. Then, one day, a trade starts to go against you. It's a position you were really confident about. Your research was solid, the setup looked perfect. But the market, as it often does, has other ideas. The price drops, hitting your mental stop loss. But instead of getting out, a little voice whispers, it'll come back. It has to. So you hold on. The loss deepens. That 10% gain you were so proud of shrinks to 8%, then 5%. Now panic starts to mix with hope. I can't take a loss now, you think. Just wait for it to get back to break even. You might even double down, adding to a losing position, convinced you can force the market to prove you right. Before you know it, a single bad decision, a single refusal to accept you were wrong, has not only wiped out your 10% gain, but has put your account in the red. 2 months of patient, disciplined work, gone in a few hours. This is the exact scenario Paul Tudor Jones built his entire career on avoiding. He famously said, "Don't be a hero. Don't have an ego. Always question yourself and your ability." When a trade goes against him, he doesn't see it as a personal insult. He sees it as the market giving him new information, and his immediate reaction is to cut the position. He understands that the goal isn't to be right on every single trade. The goal is to protect your capital so you can stay in the game to trade another day. He treats his trading capital like a general treats his army. You don't sacrifice your entire army for one losing battle. You retreat, you preserve your forces, and you live to fight again on more favorable ground. That one big loss, the torpedo, as some traders call it, is the single greatest threat to a portfolio. PTJ's first rule is all about ensuring that torpedo never hits your ship. This brings us directly to the practical application of his first rule, which is his second core principle. Always use a stop loss, even when you're sure. A stop loss is a predetermined order to sell a security when it reaches a certain price. It's your automatic exit door when a trade goes wrong. For PTJ, this isn't just a suggestion. It's a non-negotiable law of survival. He has a very clear process. Before he even enters a trade, he knows exactly where he's getting out if he's wrong. He'll look at a chart and say, okay, I'm buying here at $100. If it drops to 95, my thesis is invalid and I am out. No questions asked. That price, $95, is his line in the sand. It's the point where he admits his initial idea was wrong. The key here is that this decision is made when he is calm, rational, and objective, before his money and his ego are on the line. Once the trade is on, emotion enters the picture. Greed, fear, and hope can cloud your judgment. The stop loss is your defense against your own emotional weakness. It's the sober, rational version of you, protecting the emotional, in-the-moment you from making a disastrous decision. Many traders, especially new ones, resist using stop losses. They think, what if the price dips down, hits my stop, and then shoots right back up? I'll have sold at the exact bottom. Yes, that can happen. It's frustrating. But Paul Tudor Jones would argue that getting stopped out for a small, manageable loss and watching the price recover is infinitely better than not having a stop loss and watching a small loss turn into a catastrophic one. He's not playing for one-time perfection. He's playing a game of probabilities over thousands of trades. He knows that over the long run, a handful of times he gets stopped out unfairly will be dwarfed by the many times a stop loss saves him from ruin. Being sure about a trade is one of the most dangerous feelings in the market. The moment you think you can't lose is the moment you're most vulnerable. A stop loss is your humility made manifest, a constant reminder that the market is bigger than you and that you could always be wrong. This leads us to the overarching philosophy that ties these first two rules together. PTJ's third major principle: protect the downside first. The upside will take care of itself. He has one of the most famous quotes in the trading world. I'm always thinking about losing money as opposed to making money. Now, that might sound counterintuitive. Aren't we in the markets to make money? Yes, but Jones understands a fundamental asymmetry. If you have $100,000 and you lose 50%, you're down to $50,000. To get back to where you started, you don't need a 50% gain. You need a 100% gain on your remaining capital. The bigger your loss, the exponentially harder it is to recover. Because of this, his entire focus is on defense. He calls himself a market opportunist and a premier risk manager, not a premier profit seeker, a premier risk manager. Before he makes any trade, his primary question isn't how much can I make, it's how much can I lose. He identifies his maximum acceptable loss on any given idea, and that becomes the foundation of his entire position. This is what's known as asymmetric risk-reward. He's constantly searching for opportunities where his potential upside is many times greater than his potential downside. For example, he might look for a trade where he risks $1 for the potential to make $5. He calls these 5-2-1 South. If he can find these setups consistently, he doesn't even need to be right half the time. Let's say he makes 5 trades with this 5-2-1 profile. He's wrong on 4 of them, and he loses $1 each time for a total loss of $4. But he's right on just one trade, and he makes $5. After 5 trades, despite being wrong 80% of the time, he's still up $1. This is the magic of focusing on the downside. By rigorously controlling his losses, he gives his winning trades the space and time they need to generate outsized returns. Most amateur traders do the opposite. They stumble into trades where they are risking $5 to make one. They might win frequently, taking small profits, but it only takes one unexpected loss to wipe out a dozen small wins. PTJ plays the long game. He is a defensive player first and foremost, knowing that a good defense is what ultimately wins championships in the financial markets. Finally, we arrive at the fourth and most personal of his principles, the one that governs his entire mindset: stay humble, because the moment you are arrogant, the market will humble you. Jones has said, the most important rule of trading is to play great defense, not great offense. Every day I assume every position I have is wrong. Think about that. A billionaire hedge fund manager, one of the greatest of all time, starts his day assuming he's wrong about everything. That is the pinnacle of intellectual humility. In trading, arrogance is a death sentence. It manifests in many ways: doubling down on losers, refusing to use a stop loss, over-leveraging after a big win, or thinking you've figured out the market. The market is a complex, dynamic system with millions of participants, and it does not care about your opinion, your track record, or how smart you think you are. The moment you believe you are bigger than the market, it will find a way to put you back in your place. Success can be a trader's worst enemy because it breeds overconfidence. After a string of wins, it's easy to feel invincible, to start taking bigger risks, and to get sloppy with your rules. PTJ guards against this by being his own harshest critic. He is constantly questioning his own ideas and looking for reasons why his trades might fail. He surrounds himself with people who are not afraid to challenge him. This constant self-assessment and humility are what allowed him to see the 1987 crash coming when so many others were blinded by the hubris of a long bull market. He was studying market history, looking at the parallels to the 1929 crash, and respected the possibility that history could repeat itself. He didn't let the prevailing optimism of the time sway his risk management. His journey is a testament to the fact that in the world of finance, longevity is the truest measure of success. And longevity is impossible without humility. It's the foundational trait that makes all the other rules possible. It's humility that allows you to cut a loss without bruising your ego. It's humility that forces you to use a stop-loss because you admit you Q&T predict the future. And it's humility that makes you prioritize protecting your capital over chasing heroic profits. So, let's bring it all together. Paul Tudor Jones's philosophy isn't about a secret indicator or a complex algorithm. It's a simple, robust framework for survival and success. 1. Don't let a single mistake erase your hard work. Cut your losses mercilessly. 2. Use a stop-loss, always. It's your shield against emotion and ruin. 3. Play defense first. Obsess over how much you can lose, not just how much you can win, and seek those asymmetric bets. And 4. Stay humble. The market is the ultimate teacher, and its favorite lesson is humility. These 4 pillars have not only made Paul Tudor Jones a billionaire, but they have allowed him to successfully navigate every market storm for over 40 years, from Black Monday to the dot-com bubble to the 2008 financial crisis. They are a masterclass in discipline, risk management, and psychological fortitude. Whether you're trading stocks, crypto, or just managing your own retirement account, these principles are pure gold. Thank you so much for watching. If you found this deep dive valuable, please hit that like button and subscribe for more content on the minds of the world's greatest investors. Let me know in the comments which of PTJ's rules resonates with you the most. Stay safe, stay disciplined, and I'll see you in the next video.